Right now, retail investors are screaming that the graph is a dead project. The sentiment across social media is completely buried in the trenches. And let's be entirely honest with ourselves. The price action on the chart absolutely justifies their panic. The current price of GRT is down nearly 99% from its all-time high. It has been a relentless, agonizing, multi-year bleed that has wiped out leveraged long positions, broken the spirit of the diamond hands, and seemingly relegated this once promising infrastructure project to the graveyard of the previous bull market. But if you rely solely on retail panic and social media sentiment to build your portfolio, you are guaranteeing that you will be the exit liquidity for the smart money. Behind the scenes of this catastrophic, bleeding price chart, there is a severe fundamental divergence happening right now. Despite the brutal drawdown, the data shows there are currently 24 core developers actively shipping one of the most significant AI infrastructure updates in the crypto sector. They are building a massive data moat that large language models desperately need but cannot build for themselves. And from a purely technical standpoint, the price of the graph is sitting exactly at a do-or-die structural floor. We are parked perfectly on the 1618 Fibonacci extension at 2 cents. If you ignore this specific setup right now simply because the chart looks ugly, you might be missing the exact same geometric structure that preceded a massive mean reversion back in 2023. Today I'm going to walk you through the bleeding on-chain financials of GRT, the incoming network upgrades, the macro chart patterns, and the exact step-by-step risk management strategy I am executing to protect my capital while exposing myself to this asymmetric setup. Let's ground ourselves in reality first and look at the market structure. The current price of the graph is hovering around 2 cents. We need to respect what that means. This is the absolute floor. It's the last major historical support zone before we enter complete price discovery to the downside once again. If this level breaks, there is no safety net. The overall market sentiment for GRT is pure, unadulterated fear. And frankly, the institutional footprint confirms this extreme hesitation. Recently, GRT was completely dropped from the Grayscale Decentralized AI Fund. That's a massive institutional red flag that we cannot ignore. When a major asset manager like Grayscale liquidates their position and removes a protocol from a thematic fund, it tells us that institutional smart money currently lacks the confidence to hold this asset through its transitional phase. They are not willing to take the risk on the short-term price action. So why does this video matter right now? Why are we even looking at a token that institutions are dropping? Because peak irrational fear, combined with a total wipeout of leverage, is exactly when sophisticated, data-driven investors start hunting for asymmetric risk-to-reward opportunities. The weak hands have fully capitulated. The leverage has been entirely flushed from the system. When we look at a 3-month liquidation heat map from CoinGlass for the graph, we see that price clusters are deeply compressed around the 4 cents to 2 cents range. The over-leveraged longs and the aggressive shorts are gone. They have been liquidated, leaving the asset heavily compressed at rock-bottom valuations. This absolute lack of leverage can act as a foundational concrete floor, but only if a fundamental catalyst triggers spot buying. And there is something buried in the graph's upcoming 2026 roadmap that changes the narrative entirely. First, let's open the hood and look at the raw, verifiable on-chain data, starting with the financials. I'll not sugarcoat this reality for you. Over a 180-day period, token terminal data shows protocol revenue sitting at just $77,000. For a top-tier infrastructure protocol that is supposedly the backbone of Web3, that's a shockingly low figure. It proves that despite its massive utility and integration across the space, the Graph network has struggled immensely to extract actual monetary value from its users. Now compare that tiny revenue to the protocol expenses over the same 180-day sum, which clock in at a staggering $2.6 million. The math here is brutal. The protocol earnings show a deeply negative $2.5 million. Historically, the network has been effectively subsidizing its own existence. They have been using massive GRT token inflation to pay the indexers and secure the network, continuously diluting the circulating supply and punishing long-term holders. But here is where the thesis begins to shift, and why we need to pay close attention. Recently, The massive token incentives that fueled that inflation appear to be getting cut off. The protocol expenses have started to flatline, and we are finally seeing early glimpses of positive earnings months. If the inflationary sell pressure that directly caused this 99% drop is truly evaporating, the internal market structure of GRT is fundamentally healing. Let's look at the yield angle and DeFi liquidity. If you track the yield metrics right now, a wrapped Ethereum and GRT pool on Uniswap has a total value locked of just $78,000. It's yearly yielding roughly 31%, which is good, but that total value locked is microscopic for a major cap token. What does this tell us? It tells us that major liquidity providers are sitting on the sidelines. They are not willing to risk impermanent loss to provide liquidity for GRT right now. Furthermore, looking at active engagement, the transaction count over a 180-day sum is just 138,000, placing the graph 47th in the infrastructure category. On-chain contract interaction is incredibly stagnant. So, with bleeding financials and low liquidity, why am I analyzing this asset? Because of the 2026 technical roadmap. The graph is undergoing a massive, painful, but necessary transition to become the foundational data layer for artificial intelligence. Right now, there are 15,500 structured databases of on-chain data existing on the Graph network. Your favorite AI has no idea this data exists. Large language models are completely blind to live blockchain data without a bridging infrastructure. The new roadmap extends in two vital directions. First, tighter economic alignment for network indexers to fix the revenue problem. Second, native AI compatibility through new standards like X402, Machine Context Protocol, and agent-to-agent support. Any on-chain dataset can now be wired directly into an AI assistant as a live, queryable tool in a single afternoon. The Graph is building a product called Token API, which will deliver pre-indexed, production-ready access to data across 10 networks today, with real-time decentralized exchange pricing rolling out by Q3 of 2026. Every single wallet, every block explorer, and every analytics platform needs real-time token balances and pricing. This opens up a highly lucrative, enterprise-grade customer base that can actually generate revenue. This is exactly why researchers are quietly adding GRT to their 2026 AI Catalyst watch lists, placing it right alongside heavy hitters like Tau, Render, and Fetch. They are watching the upcoming Horizon mainnet upgrade. The narrative is attempting to shift from a simple Web3 indexing tool to the undeniable Google of crypto hitting its final form. But narratives don't matter if the chart breaks down. So, let's take all of that fundamental data and map it directly onto the weekly price chart, because the chart is where truth is ultimately realized. We are zooming out to the macro weekly timeframe to filter out the daily noise and look at the actual market structure. Currently, the price action for GRT is sitting inside a massive falling wedge pattern, marked by the white dotted lines on my screen. This wedge began forming at the end of 2024. It has been getting tighter and tighter, continuously squeezing the price action downward, and it officially tested the critical lower support boundary in February. But the structure is heavily suppressed. We also have a massive macro yearly descending trend line, indicated by the orange dotted line. This trend line is a ghost from the past, originating all the way up from the all-time high regions around $2 back in 2021. We saw aggressive rejections off this line in late 2021, and it slapped the price down twice again in 2024. It's the ultimate macro boss-level resistance. Until GRT breaks that orange line, any pump is just a lower high in a macro bear market. When we look at the moving averages, the picture is undeniably bearish in the short to medium term. The price is currently drowning below every single exponential and simple moving average on the weekly chart. We are trading below the 10 in blue, the 21 in red, the 55 in purple, the 100 in yellow, and the major 200 simple moving average in green. Every single one of these bands is acting as overhead dynamic resistance, pressing the price down. We have no moving average support. However, let's look at the Fibonacci retracement and extension levels. If we anchor our Fibonacci tool from the exact macro low of 7 cents in 2023 and drag it up to the local top of 50 cents in 2024, a fascinating and terrifying geometric alignment appears. Following that major pullback from the 50-cent high, the exact mathematical destination to the downside was the 1618 Fibonacci extension. And exactly where is the price of GRT sitting right now? Perfectly on that level at roughly 2 cents. This is where historical market structure provides our analytical edge. I'm seeing the exact same geometric pattern and retracement from the 2021 to 2023 bear cycle attempting to play out again right now. During that last cycle, the price formed an identical falling wedge, bottomed precisely at the 1618 fib extension, and then initiated a massive relief rally. In that previous expansion move, the price pushed up and nearly tagged the 0618 fib retracement level. If we assume history might rhyme, and this 1618 level holds as the absolute cyclical floor, the next major upside target aligns perfectly with the descending macro trendline resistance. That intersection lines up exactly with the next 0618 fib level at 15 cents, projecting roughly into Q4 of 2026. Additionally, look at the Heikin-Ashi Relative Strength Index indicator at the bottom of the chart. It's reading extreme oversold conditions. This extreme compression is a classic hallmark of a project carving out a macro bottom. But let me be perfectly clear, because I don't want anyone getting wrecked here. We desperately need a strong, high-volume bullish green Heikin-Ashi candle to confirm any sort of trend reversal. Until GRT flips the closest important resistance zones at 5 cents and 8 cents into support, this asset remains a falling knife. This brings us to the execution phase. How am I personally managing this setup? First, I want to emphasize heavily that my long-term bag for the graph is very, very small. Capital preservation is always priority number one in this market, and any token down 99% requires extremely strict risk sizing. You don't bet the farm on a turnaround play. My strategy here is purely mechanical and devoid of emotion. I'm not selling any of my long-term GRT holdings during this phase of peak irrational fear. The fundamental data shows the engineering team is still building, and the technicals show we are at the ultimate support box. But if the price fails here, and we see consecutive weekly closes below the 2-cent level, this entire setup is completely invalidated. That would be a structural tragedy, and we would expect a flush to much lower, undiscovered price levels. This 1618 Fibonacci at 2 cents is literally the last hope for the macro price action. However, if Bitcoin can remain stable and successfully consolidate above the $75,000 level, and the AI narrative catches a fresh bid in the traditional markets, GRT has the framework for a significant reversion to the mean. This is one of my asymmetric AI plays. For the position traders managing this risk, my profit targets are laid out sequentially. Target 1 is the immediate resistance at 5 cents. Target 2 is 7 cents. Target 3 is the major Fibonacci level at 15 cents. Target 4 is 25 cents, and the final macro target is 50 cents. I'm deploying a strict trailing stop-loss mechanism. If the price achieves that first target of 5 cents, my stop-loss immediately moves up to my entry point. It instantly becomes a risk-free trade. If we hit the second target of 7 cents, the stop-loss moves up to target 1. We lock in the yield, protect the capital, and let the rest of the position ride the volatility. For short-term traders, this 2-cent floor presents a highly defined entry zone with an incredibly tight stop-loss just below the recent wicks. The risk-to-reward ratio is excellent, but the probability of failure is still high. Respect the data and remember, this is simply my personal strategy and is definitely not financial advice. To synthesize this entire analysis, we have a protocol on the graph that is fighting for its life with bleeding revenue and a completely destroyed chart. That is exactly why retail has abandoned it. But beneath that surface, we have 24 core developers shipping enterprise-grade AI data architecture. The aggressive token inflation incentives are finally flatlining, and the chart is resting perfectly on a historically proven Fibonacci reversal level. The asymmetry here is clear, but it's dangerous. The downside risk is technically defined just below 2 cents. If it breaks, it is over. The upside potential targets 15 cents and beyond, but only if the 2026 roadmap successfully captures the artificial intelligence market share and the macro environment allows for risk-on behavior. The ultimate wisdom here is that markets are mechanisms that transfer wealth from the impatient to the patient, and from the emotional to the analytical. You do not make real yield by buying green candles when the news is universally positive. You make it by stepping into the blood with a calculated, mathematically defined framework while everyone else is paralyzed by fear. You define your risk, you accept the probabilities, and you let the chart decide the outcome. If this breakdown brought you clarity and helped you step away from the noise today, please hit the like button and subscribe to the channel so the algorithm knows you value serious, data-driven market intelligence. Now, if you want to move beyond just watching YouTube videos and actually see how I manage these specific setups in real time, I invite you to join the Pro Capital Vault. This is my private Discord community, and you can get immediate access right now by becoming a YouTube member of this channel. Inside the vault, you get direct access to my real-time portfolio tracking, my exact buy and sell zones, our weekly live strategy calls, and my Sunday prep report where I map out the macro environment before the traditional markets even open. It's a room built for serious, data-focused position traders. If you want to work side by side with me and elevate your risk management, simply click the join button right below this video, use the link pinned in the top comment, or scan the QR code currently on your screen. Once you join through YouTube, just remember to sync your YouTube account to your Discord app to automatically unlock all the private channels. I highly recommend you go watch my last video covering the previous macroeconomic cycle for the graph, as it seamlessly continues the framework we discussed today. Let's stay objective, respecting our invalidation levels and managing our risk. Much love for watching till the end, and I'll see you soon in the next one.